This is Monetary Metal Masters. Not financial advice, educational only. Japan looks fine if you only stare at the Nikkei. Stocks are flying. But the real story isn't prosperity, it's financial repression. Here's the setup. Japan has carried a debt burden that, in your source, is described as roughly 250% of GDP. That's not a typo. And the way you sustain that kind of debt is simple. You hold rates down, you print, and you push savers into risk. That's why the yen carry trade matters. When Japanese rates sit near zero, global investors borrow yen, sell yen, and buy assets elsewhere. It's a structural pressure on the currency. It's also rocket fuel for asset prices. Because when money is cheap and abundant, it has to go somewhere. But the bill arrives when inflation persists and bond yields rise. Higher yields mean higher interest expense on a mountain of debt. And politically, the response is usually not austerity. It's more stimulus, more support, more money creation. Now look at the signal Japan can't hide. Gold priced in yen. If gold in yen is making long-term highs, that's not gold doing something magical. That's the yen being worth less over time. And here's the risk. Confidence breaks fast. Currency crises aren't linear. They're psychological. When people decide they don't want to hold the currency or the bonds anymore, they rotate into real assets. Companies, commodities, and especially monetary metals. So if you want a simple framework, Japan isn't just a country story. It's a preview. Debt plus repression, plus stimulus eventually becomes anything but the currency. If you want disciplined silver mining frameworks and weekly structural monitoring, subscribe, like, and check the link in bio. Prepare, position, preserve.